Good morning, everyone. This is Marshall Giller bringing you the morning comment for January 7th. The focus now is on the extraordinary moves in fixed income. European bonds are vacillating between discounting quantitative easing on the one hand and worrying about a Greek exit from the Eurozone on the other. Meanwhile, there seems to be a flight to safety, or perhaps just capital flight, into U.S. Treasuries. Now, there are probably two reasons why yields are coming down around the world. First, the fall in oil prices has pushed down inflation expectations everywhere. Secondly, there's a shortage of safe assets in the Eurozone. The bond market is relatively small, and a lot of the bonds are already in the hands of hold-to-maturity investors. So expectations of quantitative easing, which will force the ECB to buy at any price, have made investors almost indifferent to the price at which they buy because they know they'll be able to unload the bonds in the future at a higher price to the ECB. For this reason, yields in the U.S. are likely to remain much higher than those in Europe. So even though U.S. interest rates have fallen, their spread against other major markets continues to be attractive, particularly on a real yield basis. That means the dollar should remain supported, in my view, even if the Fed funds rate expectations are declining. In any event, the euro hasn't been able to sustain any rallies this year, and so looks chronically weak to me. The New Zealand milk auction went better than yesterday, and the Kiwi gained slightly. However, it wasn't enough to turn around expectations for the commodity, and so I don't think it signals a real turning point for New Zealand and US. As for today's highlights, during the European day, the main event will be the Eurozone preliminary CPI for December. The forecast is for the bloc to fall into deflation. This adds pressure on the ECB to inject further stimulus when it meets on January 22nd, and so should be negative for the euro. In the US, the Fed releases the minutes from its latest policy meeting when officials removed the considerable time phrase from their guidance and instead said the committee can be patient in beginning to normalize the stance of monetary policy. So the market's going to look into the minutes for more insights regarding the meaning of the new phrase, just how long is patient. The ADP employment report for December is also out. It's expected to show that the private sector gained more jobs in December than it did in November, which could also be dollar supportive. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.